Welcome to Breaking News to Trading Moves.
Glad to be here.
So, for the last year or so, if you weren't talking about GPUs, you were practically invisible in the market. I mean, it was all anyone cared about.
Oh, absolutely. It was the only game in town.
Right. But what if the next massive AI windfall isn't in graphics cards at all? What if it's actually in the legacy hardware that, we all just kind of stopped paying attention to?
That is exactly the reality we are facing right now.
Yeah. And today, we're looking at a specific headline about Intel's earnings reaction. And for you listening, we are going to figure out the clear winners and losers based on all this new information.
It is a really vital rotation to break down.
Definitely. So the headline we're focused on is exactly this. Intel stock surges as AI server demand brings back the CPU trade.
Right.
So the central question for our discussion today is simple. Is this purely an Intel relief rally, or is it the start of a broader rotation into physical AI infrastructure?
Well, to set the proper stage for this, we really have to look at the current state of the market. And the market is clearly looking well beyond just GPUs right now.
Okay, so expanding the focus.
Exactly. For a long period, the graphics processing unit was the exclusive darling of the AI trade. The trade is expanding into CPUs, servers, data center hardware, and even the semiconductor equipment required to build all of it.
Right, it's a broadening of the hardware requirements across the board.
Yes, exactly.
And for you listening, we are going to walk through exactly which companies fall into the winner and loser categories based on this rotation. And most importantly, we'll look at why the capital is moving between them.
Because the capital is definitely moving.
It is. So to understand the mechanics here, we first have to look at the direct beneficiaries of the headline itself. That means CPU and AI server processors.
The obvious direct winner here being Intel, ticker INTC.
Yeah, Intel. So why exactly are they the direct winner based on this specific text?
Well, investors are actively starting to reprice Intel's AI server CPU recovery story. I mean, when we talk about an earnings reaction in this context, we are talking about new data forcing the market to adjust its forward-looking expectations.
So they are plugging new numbers into their models.
Right, exactly. Strong server CPU demand is the exact catalyst driving this repricing. The market is looking at the initial numbers and adjusting the valuation model for Intel based entirely on this specific server-side demand.
Which honestly was largely ignored when everyone was just staring at graphics processors, right?
Oh, completely ignored. People just forgot about the server CPUs.
Wow. We also have Advanced Micro Devices, ticker AMD, listed as a close U.S.-listed competitor in data center CPUs. They stand to benefit if attention moves beyond GPUs as well.
Absolutely. AMD is right there with them.
Let me try to visualize this. Think of a GPU like a hyper-specialized race car. I mean, it can go incredibly fast, do complex math at lightning speed, but it doesn't really know how to carry cargo or navigate traffic on its own.
That is a great way to look at it.
The CPU is the engine of the heavy hauler carrying the actual data. It handles the system memory, manages the network, and spoon-feeds the data directly to the GPU race car. You literally cannot build a functioning AI server with just GPUs, right?
No, you can't. You need those heavy-duty CPUs to orchestrate the whole thing. A GPU cannot function in isolation.
Okay, so if the market is moving past just looking at GPUs, what is the specific case for repricing these CPU recovery stories?
Well, the specific case relies entirely on that structural relationship you just described. Strong server CPU demand is a driving force because of the system architecture.
Because the GPU needs the CPU to operate.
Exactly. The CPU allocates the tasks, manages the system memory, and orchestrates the massive flow of data into the GPU. So, if there is a surge in demand for AI servers, there is a mandatory corresponding demand for the server CPUs required to run them.
That makes total sense.
Yeah, and AMD stands to benefit alongside Intel because both companies supply these essential foundational processors. If the total volume of enterprise AI servers goes up, the total addressable market for their specific architecture increases right along with it.
Okay, so Intel and AMD are churning out these heavy-duty CPUs, but they don't just float in the ether,
Yeah.
They have to live inside physical server racks.
Right, they need a physical home.
And that completely changes the game for the companies that actually build the boxes. Which brings us to the second group of winners. We are looking at Dell Technologies, ticker DELL, Hewlett-Packard Enterprise, ticker HPE, and Super Micro, ticker SMCI.
The server builders.
Yeah. But wait, I have to push back a bit. I'm not buying that jump just yet. Just because I'm buying more engines doesn't automatically mean the car manufacturers win. Does a recovery in CPUs automatically mean a win for the server builders?
Well, it means a massive quarter, specifically if investors choose to treat AI as a full infrastructure cycle rather than just a chip cycle.
Okay, break that down for me. Infrastructure cycle versus chip cycle.
Sure, a chip cycle focuses narrowly on the components. It's the market rewarding the companies that design and manufacture the individual processors.
Right.
But a full infrastructure cycle encompasses the entire physical ecosystem. So stronger server CPU demand points directly to continued spending on AI servers, enterprise hardware, storage, and full data center buildouts.
Ah, I see. So what does that actually look like for a company like Dell or Supermicro?
Well, companies like Dell, HPE, and SMCI, they don't just sell chips in a metal box. They sell the assembled, integrated, rack-scale server units.
Which is way more complex.
Incredibly complex. When you are running dozens of high-powered GPUs and CPUs in a single server rack, the engineering challenge is massive. These integrators design the architecture that houses the processors.
They had to keep the things from catching fire.
Literally, yes.
Yeah.
They implement the necessary liquid cooling systems to prevent the silicon from melting down, and they engineer the complex networking to connect thousands of storage drives. So if capital is moving into the idea of full physical data centers, the integrators who supply and warrant that physical hardware become direct beneficiaries. They capture the margin on the entire integrated system.
Not just the individual pieces inside.
Exactly.
Okay, that makes perfect sense. Because building more of those integrated servers, CPUs, and memory requires the actual physical tools to manufacture them in the first place.
It all flows downstream, or upstream, depending on how you look at it.
Right. And that leads us directly into the third group of winners, the semiconductor equipment suppliers. We have Applied Materials, ticker AMP, Lam Research, ticker LRCX, and KLA Corporation, ticker KLAC.
The tool makers.
Exactly. Why would sentiment turn positive for equipment suppliers right now?
Well, you can't just snap your fingers and create millions of new advanced server CPUs out of thin air. As chip demand broadens from GPUs into CPUs, memory, and foundry capacity, these specific companies benefit because they supply the highly specialized manufacturing tools.
They supply the tools required for advanced semiconductor production.
Right. The foundries are locked in a literal arms race right now. If a foundry wants to pump out more complex AI processors, they can't use last year's machines. They have to buy the newest tech from these specific equipment suppliers.
Let's talk about that complexity for a second. What kind of tools are we actually talking about here?
We're talking about manipulating materials at the atomic level. It is incredibly precise, highly complex machinery.
Like lasers and chemicals?
Basically, yeah. The foundries have to purchase specialized tools for things like extreme ultraviolet lithography, chemical vapor deposition, and advanced packaging.
Advanced packaging.
Yeah, so right now, chips are no longer just flat pieces of silicon. They are stacked vertically in 3D structures. And that requires entirely new sets of multi-million-dollar tools to etch microscopic patterns and connect the layers.
That sounds wildly expensive.
It is. If the overall demand for chips is broadening, the foundries must expand their physical capacity to meet it. That expansion requires a massive influx of capital expenditure on new equipment.
So positive sentiment just naturally follows the logical flow of capital up the supply chain.
Straight into the pockets of the equipment makers, yes.
Okay, but money flowing into CPUs, server racks, and manufacturing infrastructure has to come from somewhere, right? It's not infinite.
It is definitely not infinite.
Which brings our discussion to the losers category. The first group identified here is the crowded AI chip momentum names. We were talking about NVIDIA, ticker NVDA, and ARM Holdings, ticker ARM.
That's right.
Let me point out a contradiction that immediately stands out to me. These are some of the most famous, highly profitable names in the entire AI space. Are the notes saying these are weak businesses?
No, absolutely not. The underlying businesses of NVIDIA and ARM remain exceptionally strong.
Okay, good. So what's the issue?
The risk here is strictly a matter of market rotation and liquidity mechanics. Intel's rally could encourage traders to move money out of these crowded AI winners and into the less-owned CPU recovery names.
Let's look at the mechanics of liquidity in a crowded trade. Why does a strong business become a loser in this specific trading dynamic?
It comes down to how institutional capital is managed and the constraints of portfolio weighting. When a trade is described as, crowded, it means a vast majority of market participants already hold maximum allowable positions in those specific stocks.
So they literally can't buy anymore.
Exactly. NVIDIA and ARM Holdings are the most widely owned AI chip momentum names. Because so many mutual funds and hedge funds already own them, the available pool of new marginal buyers shrinks.
So if you are a portfolio manager and NVIDIA is already like 10% of your book, you hit a wall.
You hit concentration limits. Now, when those same traders see Intel's positive earnings reaction and recognize a newly emerging CPU recovery story, they want to allocate capital there.
To capture that potential upside.
Right, but they need cash to make that purchase. To fund those new positions in Intel or AMD, they are forced to sell portions of their existing positions in NVIDIA or ARM.
Wow, so it's just a reallocation of resources.
Exactly. The stock price of the momentum names might face downward pressure simply because traders are rotating their capital into new opportunities. They take profits from the winners to fund the next phase of the trade.
Okay, that makes a lot of sense. So aside from the crowded chip momentum names, capital is also rotating away from sectors that are taking longer to prove their financial viability in the AI space.
Software names.
Right, which brings us to the enterprise software names. Salesforce, ticker CRM, Adobe, ticker ADBE, and ServiceNow, ticker NNowW.
This is a really key dynamic.
I have to ask, why would software lag behind hardware right now? Every dollar an IT officer spends on a massive Dell AI server is a dollar they can't spend on a new Salesforce subscription.
That is the exact battle taking place. It's a classic battle between capital expenditures for hardware and OpEx operational expenditures for software subscriptions.
So hardware is basically eating the corporate IT budget.
Right. Intel's strong reaction supports the idea that investors currently prefer companies selling the physical AI infrastructure over software companies. And that is because the software companies are still actively proving their AI monetization.
So capital will keep flowing to hardware as long as that proving phase continues.
Exactly. It's a matter of immediate revenue versus projected revenue. When an enterprise decides to build out an AI data center, they purchase the hardware immediately.
Right, the server builders and chip designers book that revenue in the current quarter.
Yes. But the enterprise software companies operate on a completely different timeline. They must spend their own capital to develop AI features, integrate those features, and then go out and convince their clients to pay higher monthly subscription fees.
Oh, wow. So the software companies carry the entire burden of proving that their AI tools actually generate a return on investment before they see a dime of upgraded revenue.
That is exactly it. A company like ServiceNow or Adobe has to prove that their new AI assistant actually saves a client enough labor hours to justify, say, a 30% price hike.
Which is a really tough sell right now.
It is a much slower, much more difficult sales process. Meanwhile, investors are observing the immediate, tangible financial results coming from the hardware sector.
Because it's a zero-sum game with corporate budgets.
Right. If spending is heavily skewed toward buying physical infrastructure right now, the software renewals and upgrades get delayed. Software names could lag simply because investor preference is chasing the companies booking the immediate infrastructure revenue.
Fascinating. So to clarify that not all hardware is a winner, we really have to separate enterprise-level infrastructure from everyday hardware.
Right. Very important distinction.
That brings us to our final group of losers, the legacy, PC, and consumer hardware names. We are looking at HP Inc., ticker HPQ, and Logitech, ticker LOGI.
The consumer stuff.
Right. I like to think of this dynamic like buying commercial farming equipment versus buying a backyard garden trowel.
That's a good analogy.
I mean, they both technically involve tools for the dirt, but the scale, the purpose, and the capital required are in entirely different universes.
So can you verify why the traditional PC market is excluded here?
Yeah, the mechanics are tied specifically to the location of the capital expenditure. Intel's strength in this narrative is tied strictly to AI data center demand, not traditional PC or consumer hardware demand.
It's all enterprise level.
Exactly. The massive spending we've discussed is focused entirely on building out server racks, power delivery, and data centers. It is not occurring at the consumer level. Everyday consumers are not driving this cycle at all.
So people aren't rushing out to buy new mice and keyboards.
No, the consumer hardware replacement cycle is actually quite stagnant right now. Everyday corporate office workers aren't getting new laptops at a rate that matches the enterprise infrastructure build-out.
Because all the money is going to the server room. Right. The market is hyper-focusing its attention and capital on the AI server infrastructure. So companies like HPQ and OGI, which rely heavily on legacy consumer upgrade cycles, simply do not capture that same momentum.
The enterprise dollars are flowing to Super Micro and Dell, not to consumer PC manufacturers.
Exactly.
All right, so to summarize our key takeaways from this breakdown, the earnings reaction challenges the pervasive idea that the AI trade belongs strictly to GPUs.
It is so much broader now.
Right, the market is now actively pricing in CPUs, physical servers, advanced manufacturing equipment, and data center infrastructure as vital parts of the ongoing AI story.
And the trading themes to watch moving forward include a long CPU recovery, a long physical AI infrastructure cycle, and a distinct rotation away from crowded AI momentum names and slower growth software companies.
Well said. So I want to leave you listening with a final thought to mull over. If the market is heavily rotating from software promises to physical infrastructure today, what happens to the market landscape when that physical infrastructure is finally built?
That is the big question.
It really is. This is not financial advice or buy or sell recommendations. This is purely the opinion of the author.